So today I thought I'd talk about something that I thought would be quite interesting to talk about, a bit of a topic at the moment, but something also a little bit controversial. I know I'm going to get a few people with that headline of "Don't buy the S&P 500" and a few people going, "What? It's always good, historically proven, good to buy the S&P 500." So admittedly, there was a little bit of clickbait on that title, so you clicked on this video, but I do generally think that buying the S&P 500 is still a good idea. If you're trying to, invest and you don't want that much risk, the S&P 500 is still a great idea. At the end of the day, it's still investing in the S&P 500 is still massively better than keeping money in your bank account and losing out to inflation. The S&P 500, in my opinion, is still a very good investment, especially when you don't want that risk, that volatility. If you don't have the time to kind of research stocks and how that investment's going and putting in the upkeep as well, I think for the average Joe, investing in the S&P 500 is still a brilliant idea and something that you want to be doing. But I'm going to come at this from an angle today of don't invest in the S&P 500 and expect the same results that we've had in the last 5 years. I think the S&P 500 is going to be a little bit more underperforming in the coming few years, and let me explain why. So the S&P 500 in the last 5 years has performed absolutely amazing. The average return for the S&P 500 is around 8%. Some people say 9%, depending where you go from. But we'll just say 8% today. So we say the S&P average return is 8%. Now, in the last 5 years, if we have a look here, the average return, obviously at the moment, it's having a bit of a dip. As you can see down here, we're going through this crash at the moment, this worst crash since 2008, so obviously there's been a few gains wiped out here. But let's just say we don't take that crash into consideration. The S&P 500 is actually up 86%, as you can see here. So this has massively outperformed the average return of 8%. So obviously at the moment, the S&P, if you look at that period from 2017 and we go from, October time and we just ignore this dip that we're on at the moment, you can see here basically in that kind of 4-year, 5-year time frame, the S&P 500 has historically outperformed what it averagely brings in at the moment, and it's performed very well. And it's actually performed that well that you're looking at and going, well, all I need to do is put my money in the S&P 500. I don't need to do any work. It's given me a very good return, as good as a return nearly as if I invested in something, say, an Apple, for example. If I invested into Apple, sure, I would have got more of a return, but there's that little bit more risk, that little bit more volatility, and also that's obviously not taking in consideration the dividends that you would have received as well on the indexes. But overall, the S&P 500 would look like a piece of cake really for what you would expect. You think, should I take that risk, that volatility, or buy Apple? Yeah, I could have got more returns, but why not invest in the S&P 500? Because it's still putting in amazing returns. And in my opinion, it's not going to be that simple in the next few years. In my opinion, I don't think the S&P 500 will be able to do what it's historically done, and that's perform above its historic average return. I think the S&P 500 is going to go through lower returns. And my video today is don't buy the S&P 500 expecting the performance that we've had in the last 5 years. I still think it's a good investment. I still think it's a safe investment, and it's better than doing no investments. But my video today is saying don't invest in the S&P 500 and expect the same amount of returns that we've had in the last 5 years. I think we're going to see that underperform and come back with a lower percentage return. Now, that lower percentage return will still be okay, don't get me wrong, but I don't think it'll be good as what we've seen previously. Now, the reason why I don't think the S&P 500 is going to perform as well in the next 5 years is for these reasons. Obviously, we performed absolutely amazing and we've had really high returns. But a lot of that has been because of the big tech that's been making up the S&P 500. Your likes of Apple, your likes of Microsoft. A lot of them stocks at the moment, Nvidia, have pushed to extremely higher valuations and metrics than what they historically have been. So for example, if you look at Apple, they have obviously performed well financially, but what has helped is they've expanded to 24 times earnings. Now, I remember 5 years ago, historically, Apple traded around about 13 times earnings. So even though the financials have been amazing on Apple, what has helped it is multiple expansion. Now, in the next 5 years, I don't think we can see a lot of these stocks have what they've done to help the S&P 500 and the big tech and have that multiple expansion, because I can't see why, even on the dip right now that Apple's having, which I still think isn't enough for Apple, that's trading at 24 times earnings. And what you've seen is the S&P 500, which is made up of the 500 largest companies. A lot of those 500 largest companies have benefited from the valuations that they've been trading at, the metrics they've been trading at higher than historic averages. And now a lot of them are having dips. But if we just go on this chart here from Yardeni Research, you'll see that even with the dip that we've been on, at the moment, the S&P 500 trading around 15 times earnings on a forward P ratio is about the historic average. So this isn't a case where we've had a drop and now a lot of these big techs, the S&P 500 is at crazy low valuations. It's still okay valuations. And I can't see in the next 5 years a lot of these big techs pushing to a lot higher valuations, because they're already kind of at pretty decent valuations. And what I also wanted to say is that don't buy the S&P 500 and expect the historic returns that we've had. I still think there'll be good returns in the next few years, but not as good as what we've had in the last 5 years. But I think the next thing is this is now a stock pickers market, because while the S&P 500 is down and a lot of the big tech that are in there, like your Apples, are down 20-30%, what has happened is the mid caps, the small caps, the growth stocks in the last 12 months, even for some of them even longer than 12 months, a lot of them stocks have lost 60, 70, 80, 90% of their value. And what has happened is you have had, if you look down here, mid caps are currently trading at the lowest valuations since the 2008 crash. Mid caps at the moment are at the valuation of the 2008 crash. And that's where you're having an opportunity, because we are nowhere near in that point in time where there should be that sort of valuations. The small caps are even worse. They're even potentially, you could say, below the 2008 levels. So in my opinion right now, if you're a stock picker, if you have the time, if you want to have a look at some of the small caps and mid caps, which do, in a negative market which we're having at the moment, do historically get pushed down a lot lower than the big tech. At the moment, I think if you're looking for opportunity and you're a stock picker, you really should be fancying your chances really at the moment at some of these mid caps and some of these small caps, because they are at the valuations that are extremely low at the moment. And I think that if you are a stock picker at the moment, you could argue that, okay, if you were an individual stock picker, through this period of time from 2017 to 2020, 2021, 2022, you might have made some, decent stock picks. But the argument is, from an index holder, well, I didn't have to take that risk on. I just had to put my money in there and not do any more research, and I could have walked away with 80% returns. But I think the argument is this in the next coming few years, is that the S&P will do well, and I think the S&P will bring in good returns in the next 5 years. But I don't think it will be as good as what it has been. And if you are an individual stock picker, as an individual stock picker now, there's opportunities where you can actually at the moment get really low valuations and you have tremendous upside. Upside that is a lot more because you're taking that risk on, and you're taking that risk on with an individual stock or a smaller market cap stock. More reward from taking on that risk of being a stock picker. Because I think what you've had in the last 5 years is, you can argue, you could have just bought the S&P and you've done quite well for yourself. I mean, sure, there's obviously a few individual stocks that outperform the S&P 500, but why take that risk when you walk away with 80%? I think now we're into a period of time where that S&P is going to return a lower amount than 80%, maybe 30, 40, 50%, 60% in the next 5 years. But the opportunity with a lot of these small caps being crushed, down to the levels of 2008, I think there's opportunity there where you can see a lot more reward for taking on them risk buying them stocks at the moment because of the valuations they're at. So that's the video for today, guys. A bit of a controversial topic, I'd say. Obviously, I'm still a fan of the S&P 500, but I just wanted to make a video saying I would not assume that the S&P 500 is going to bring in such high returns as it has done previously. And as well as that, if you are more of a stock picker and you are staring at some of the small caps and mid caps in the stock market crash at the moment, there lies the bigger opportunities compared to the big caps for sure. So yeah, hope you enjoyed the video anyway, guys. If you could hit the like button, if you're new, subscribe, that'd be absolutely amazing. Let me know what your thoughts are in the comment section. Do you believe that a lot of the individual stocks, small caps, mid caps, could easily very much outperform the S&P 500 compared to what it's done historically? And yeah, I'll see you in the next video.